Are you looking to invest in mutual funds but do not know where to start? This video is for you. First, let's take a look at what are mutual funds. Now, you are a person who wants to invest in the stock market, but you either do not have the time or knowledge to do so. Hence, you give your money to a professional to do it on your behalf. Similarly, there would be a lot more people giving their money as well to the professional. This money collected by the professional, also known as a fund manager, then invests your money in the market with the goal of generating returns for you. And this is called the mutual fund scheme. So, summing it up, a mutual fund is an investment scheme where funds from multiple investors are collected and invested in assets such as stocks and bonds. Now that we know what mutual funds are, let's move into the next topic, which is methods of investing in mutual funds. The first method is called lump sum investment, and the second method is called systematic investment, or also commonly known as SIP. Lump sum investment is investing a large amount of money at once, whereas SIP is investing a fixed amount of money every month. Let's take an example and see how it works. Let's assume that the returns generated through mutual funds on an average is 13% per year, which is on the lower side. So if you invest a lump sum of 60,000, at the end of the year, it would have grown to over 67,000. However, if you decide to break the 60,000 and decide to invest 5,000 every month for a year, then at the end of the year, it would have grown to just under 65,000. So that's the difference between lump sum and SIP. Coming to my suggestion, assuming you have a fixed income, I would recommend having an SIP in place to invest a certain amount of money every month, along with which, if you receive a lump sum amount of money, for example, an annual bonus, invest that as well as a lump sum. Now that we have seen the methods of investing, let's see what mutual funds can do for you. Investing in mutual funds should be usually for a long term, and I will show you why. Let's say you invest 20,000 every month. Annual step up means every year you increase your investment by 10%. So this year if you're investing 20,000 per month, next year you would be investing 22,000 per month and 24,200 per month the year after that, and so on. Let's consider the expected rate of return at 14.5%, which is on the moderate side. So in 10 years, you would have invested 38 lakhs and generated returns of close to 39 lakhs and would have a total value of 77 lakhs. At this rate, you would make your first crore in 12 years. But now, this is where things start to pick up. To make the next crore, it will take you only 3 more years, and to make your third crore, it will take you less than 2 more years. And with a total of 20 years of investment, you would have generated a total value of over 5 crores. Now, for the next 5 years, your 5 crores would turn into 12 crores, which means that on an average, you would have made more than 1 crore a year. And for the next 5 years, you would be at a total value of 25 crores, making more than 2 crores per year. And your total investment amount would be less than 4 crores over a period of 30 years. This means if you're 30 years of age now and you plan to retire at 60, you would have accumulated wealth of 27 crores by then. Similarly, if you are 29 years old, you would be at 32 crores. If you are 28 years old, you would be at 37 crores, and so on. So, the earlier you start, the quicker you would be able to generate more wealth as you grow. I will leave the link in the description. Feel free to check it out yourself. Now that you know how to calculate your possible returns, let's see how to go about selecting and investing in mutual funds. For this, I will use an example of my investing method, and these are not recommendations but my method of investing. I use a platform called Kuvera, and here is the option to select mutual funds. Once here, I make sure to select growth and not dividend. The difference is that dividend mutual funds offer you a payout at some intervals, but what growth does is they do not give you a payout, rather, they reinvest that amount that helps you to earn more income on the generated income. This is called compounding, and this is what we want for the long term. Now it's time to select the funds to invest in. I sort by high to low based on the last 3 year performance. The last 3 years have been really good to the investors, so you will see quite some good numbers. Here, I will select equity because of higher return, but it is also more risky when compared to the others. Next, for further spreading the risk within the equity segment, I select one small cap, one mid cap, and one large cap fund. Basically, these are segregated based on the market capital of the companies. But to keep it simple, small cap is the one with most risk. Mid cap is also risky but lesser when compared to small cap. And large cap is lesser when compared to both of them. In small cap, I have invested in Quant. In mid cap, I have invested in HDFC. And in large cap, I have invested in ICICI. To purchase, just click on the fund and you have the option of SIP and lump sum. Select the appropriate one and set it up. If you want to see what are the companies in which these funds invest in, you can scroll down and take a look. You will find the different companies and the percentage invested in each company. So these are the basics of mutual funds and how to get started. Let me know if you have any questions in the comments and I will get back to you on that. Thanks for watching and I'll see you in the next one.